Nobody broke into your retirement account, nobody forged your signature, nobody sent you a threatening letter. And yet, right now, the government is taking money from your retirement in 3 separate ways that are completely legal, almost invisible, and almost never explained to you before you retire. Not after a market crash. Not because of a recession. Right now, in a normal year, with your account balance sitting exactly where you left it, I want to be precise about what I mean by stealing, because that word is loaded. I am not talking about a shadowy conspiracy. I am talking about 3 specific, documented, legal mechanisms built into the tax code and monetary policy that systematically transfer wealth from retirees to the government. Mechanisms your financial advisor almost certainly never modeled into your retirement projection. Mechanisms that the people who designed them understood perfectly well and named carefully to obscure what they actually do. My name is Ben. I have spent months going through IRS publications, Congressional Budget Office projections, and Federal Reserve research papers to understand exactly how much of what retirees think they have saved they will actually get to spend. The number is not what most people expect, and the 3 mechanisms I am about to describe are the reason why. By the end of this video, you will understand exactly how bracket creep pushes retirees into higher tax brackets without any change in real purchasing power, how Social Security taxation functions as a hidden second tax on income you already paid taxes to fund, and how monetary inflation works as an unlegislated wealth transfer from savers to the government. These are not opinions, they are documented policy mechanics. And understanding them is the difference between a retirement plan that accounts for what you will actually keep and one that assumes you will keep everything the statement shows. Here is the framing to hold. Imagine you spent 35 years filling a bucket with water. Every paycheck you added more. You watched the bucket carefully. By retirement, the bucket is full. What most people do not realize is that the bucket has 3 slow drains built into the bottom, not visible from the outside, not dramatic. Just a steady, quiet flow outward that has been running the entire time. The government did not take your bucket. They designed the bucket, and they designed it with drains. The first drain is bracket creep. When you retire and begin withdrawing from a traditional 401k or IRA, those withdrawals count as ordinary income. Required minimum distributions, the mandatory annual withdrawals the IRS forces you to take starting at age 73, are calculated based on your account balance divided by a life expectancy factor. As your account grows, your RMDs grow. As you age, the life expectancy factor shrinks, meaning a larger percentage must be withdrawn each year. The combination of a growing account and a shrinking divisor means your forced taxable income increases every year in retirement, often faster than inflation adjusts the brackets. A retiree who carefully planned to stay in the 22% bracket in year 1 may find themselves in the 24 or even 32% bracket by year 15, not because their lifestyle got more expensive, but because the math of RMDs pushed their nominal income higher while bracket thresholds did not keep pace. The Congressional Budget Office has documented this effect. Higher RMD tax revenue is a projected and budgeted component of federal income. Your forced withdrawals are, in part, a government revenue stream. The second drain is the taxation of Social Security benefits, and this one has a history that should genuinely concern you. When Social Security was created in 1935, benefits were explicitly not taxable. That changed in 1983 and again in 1993. Congress introduced income thresholds above which a portion of Social Security benefits become taxable. Here is the critical detail. Those thresholds: $25, zero-zane for single filers, $32,000 for married couples, were set in 1983 and have never been adjusted for inflation. not once in over 40 years. Because the thresholds have never moved, more retirees cross them every year simply due to inflation pushing nominal income higher. The Social Security Administration's own data shows that in 1984, roughly 10% of recipients paid federal tax on their benefits. Today, that figure is closer to 56% and rising. More than half of all Social Security recipients are now paying income tax on money they already paid payroll taxes to fund. This is not a tax increase that was voted on or debated. It is a stealth expansion created entirely by leaving thresholds frozen while inflation does the work. The government collects more Social Security tax revenue every year without ever voting for a rate increase. They just leave the brackets in place and let time do the rest. The third drain is monetary inflation as a deliberate policy tool, and in dollar terms, it may be the largest of the three. The U.S. government carries approximately $36 trillion in debt. When the government allows inflation to run at 4 or 5% while paying 2 or 3% interest on older debt, the real value of what it owes decreases. The government pays back creditors in dollars worth less than the dollars it borrowed. The gap between the inflation rate and the interest rate is called financial repression. For a retiree holding government bonds or significant cash savings, financial repression is a direct transfer of purchasing power from them to the government. You lent the government money at 2%. Inflation ran at 5%, you lost 3% of purchasing power per year. The government gained the equivalent on the other side of that transaction. Federal Reserve research papers discuss financial repression openly as a historical debt management tool. It was used extensively after World War II to reduce the debt to GDP ratio. It is being used again now. And retirees who hold large amounts of fixed income or cash, which is exactly what conventional retirement advice steers toward, are the primary recipients of the transfer. So what do you actually do with this? Understanding the drains is only useful if it changes your planning on bracket creep and RMDs. The most powerful tool available is Roth conversion before you reach RMD age. Every dollar you convert from a traditional IRA to a Roth IRA during early retirement, ideally in a lower income year, before Social Security begins and before RMDs kick in, is a dollar that will never be subject to RMD calculations and will never generate taxable income in retirement tax. The tax is paid once, at your current rate. Everything after grows and distributes tax-free. For people in their early 60s who have not yet claimed Social Security, the conversion window is often the most valuable tax planning opportunity of their financial lives. Most people miss it entirely on Social Security taxation. The combined income calculation, adjusted gross income plus non-taxable interest plus half your Social Security benefit, allows you to actively manage which income sources you draw from in which years to stay below the thresholds. This requires knowing the thresholds exist and planning around them deliberately rather than discovering them on your first tax return in retirement. On inflation and financial repression, the defense is a portfolio that holds enough real assets, equities, real estate, inflation-protected securities to generate returns above the inflation rate. Retirees most damaged by financial repression are those who shifted entirely into bonds and cash as they aged. Retirees who maintain purchasing power are those who kept enough in real assets to stay ahead of the depreciation. None of what I have described is illegal. None of it is hidden in the sense of being classified. All of it is documented in public law and government publications. The reason most people do not know about it is not because it is concealed. It is because the financial planning industry does not teach the distribution phase with the same rigor it applies to accumulation. Your advisor helped you build the bucket. Very few advisors explain the drains. Now you know the drains exist. Plan accordingly.